There's some information that came out recently that shows that investors are making some really poor decisions based on politics. And if you think possibly you're too wise or too smart to fall victim to this, wait until you see the fourth slide. So anyway, what we're looking at in this first slide, though, is a chart of the Michigan Consumer Sentiment Index. Now, before I get into the chart, let me just explain that. A score of 100 is considered average or normal based on how people felt during the baseline in 1966, okay? So in general, anything like above 100 is optimistic, or more specifically, maybe 110 to 120 is very optimistic. Anything from 90 to 110 is normal to moderately optimistic. Maybe 70 to 90 is weak consumer confidence. Below 70 is high consumer pessimism, and anything below 60 is extremely pessimistic. Now, what we're looking at here is notice from 2016 up to 2020, Republicans were quite optimistic with a score clear up around 120 with their own personal finances and the overall view of the economy. Democrats were hovering around 80. Now, look what happened. This is what's kind of crazy. Look what happened right at November 2020. They completely flip-flopped overnight almost. And Democrats became far more optimistic about their own personal situation, and Republicans became far more pessimistic, although both of them dropped somewhat. And then, of course, again, in November of 2024, again, they completely flip-flopped overnight, and Republicans immediately became more optimistic, and Democrats became very pessimistic. Now, things don't change that rapidly with businesses and the economy and the stock market. So let's get into this a little bit further. Now, this is from a Gallup poll last year in June of 2025. And I just want to take a look at one figure here. This is measuring whether they believe the worst is behind us or ahead of us when it comes to the stock market. Now, the worst is behind us. Republicans, 75% thought the worst was behind us. Democrats, only 11%. But look at the worst of ahead of us. Again, completely flip-flop, only 24% of Republicans. But 88% of Democrats thought the worst was ahead of us. Now, this is nothing new. This is from a study that was published back in 2012 from multiple universities. Let's just take a look at the conclusion of this study. We find that individuals become more optimistic and perceive the markets to be less risky and more undervalued when their own party is in power. These shifts in perception and risk and reward affect investors' portfolio decisions, specifically when the political climate is aligned with their own political identity. Investors increase allocations to riskier assets and exhibit a stronger preference for higher market beta. That means more risky, more volatile investments. Now, that's kind of crazy. But one of the most surprising things came from a study published last year related to all of this. One of the big surprises, recent studies found that polarization to be most pronounced among those who are more numerate or math savvy, more financially literate, and more educated. They are more able to develop a plausible narrative for why they should remain optimistic or pessimistic, even when conditions have objectively changed. Okay, so that's kind of surprising also. But what we want to remember is we should not be making decisions based on politics. What we're looking at here is a chart of how $1 invested back in 1961 would have grown in the S&P 500. And notice we've had lots of different presidencies, Republicans, Democrats, and so forth. And notice in general, the chart just keeps going up left to right, okay? So we should not be making decisions based on politics. Because look at these returns. This is the returns of just the S&P 500, including its dividends, ending in 2025. So the last 5 years, 14.45%. Last 10 years, almost 15%. Last 15 years, over 14%. Last 30, 8.81. Last 40, 10.36. 30 and 40-year periods includes multiple wars, okay? A pandemic, the housing crisis, the dot-com bubble, 9/11, lots of things. And yet it just keeps chugging along over the long term. So the stock market is not a voting machine. Okay, there are many things that affect the stock market and long-term investing far more than politics. Okay, number one is corporate earnings, innovation, and productivity. That's the number one driver of the overall stock market. Monetary policy, naturally, the Federal Reserve and interest rates. That's of course tied to inflation. Okay, that affects borrowing costs, consumer spending, corporate profits, and so forth. We have unexpected events, okay, just completely unforeseen events. They could be pandemics or supply chain disruptions, oil prices, wars, who knows. Okay, economic growth. If the GDP is growing, okay, a growing economy typically leads to more jobs, more stronger consumer spending, higher business sales, and increased profits. And of course, consumer spending is vital because it accounts for 70% of the US GDP. When consumers spend more, okay, businesses keep earning. So over the long run, earnings matter far more than elections. So I hope this has been helpful. What we need to do is stick to a game plan, regardless of all the market swings, ups and downs, and which political party is in power. We just need to stick to our game plan, kind of tune out the news is usually a good idea, and keep emotions out of investing. So I hope this has been helpful, and thank you for watching. I will see you next time.